Do you put off looking at your financials every month because you're scared to death? I'm just curious because we know a lot of business owners. We work with a lot of owners that do this. They don't know what they're looking at. They don't want to deal with it. It's too much stress. It's not what they're good at. So they neglect it. Well, let me tell you, you are not alone. Hey, I'm Dave Evans, the managing partner for Exxon, and our job, our purpose in life is to build better business owners. So today, let's talk about financials and get you unafraid and give you the ability to do those weekly, monthly, and quarterly reviews of your financials like every good business owner should. We see in a lot of times that a business owner's fear of financials is limiting their business potential. Let's not have that happen. So let's jump into this. What is all this financial stuff? I mean, I'm not an accountant. I'm not a CPA. I don't want to do this. It's so hard. With these big terms like common size financial statements and gross profit margins and statements of cash flows and ratio analysis. I hated math in high school. I mean, why are you doing this to me? Look, I get it. But we're going to simplify it to you so you can understand what you're looking at and better manage your business and be a more effective, efficient, and profitable business owner with less stress in your life. Financial knowledge is an extremely powerful tool that enables owners to use what happened in the past to improve the future. The key with this is it forces you to be proactive instead of being reactive. And if you're reacting, then you're going to have problems in your business and you're going to be stressed out all the time, fighting fires and freaking out. So let's demystify the numbers a little bit. We're going to talk about four things: the income statement, the balance sheet, common size statements, and your statement of cash flows. And we're going to make them really simple for you to understand what they do and why they're doing it to you and how you should read them to be more effective as a business owner. Because it's not your job to know everything, but it is your job to understand where the money's going and where you can make changes to more effectively and profitably run your business. So the key with any general financial statement review is to understand the numbers and be able to ask the right questions. It also helps you recognize the implications of certain decisions you may or may not want to make. And it's really best to have 3 to 5 years, but most businesses don't have this, and most of it's pretty messed up, to be honest with you. So start with month 1, get the first month right, and then compare it to the next month, and the next month, and the next month. And before you know it, you have those 3 to 5 years available, and you can make great decisions. It's really simple to download or export a spreadsheet out of QuickBooks if you're using it, or if you're using FreshBooks, same thing there, of your profit and loss or income statements, as well as your balance sheet and your statement of cash flows. I would encourage you to do that on a weekly basis and review your numbers and make sure everything makes sense, especially after we talk about what it means to make sense after today. So this is a typical income statement for a company. This is a 4-year statement. It's basically showing you the big picture stuff: total revenue, cost of goods sold, your gross profit, then itemizes your operating expenses to see what your total operating expenses are, shows your net income before tax, and then your net income. This is easy for me to say. This is confusing and hard to read sometimes, especially if you don't know what you're looking at. The key to all of this is to simplify. So let's talk about this. Your common size income statement. This is going to convert all those numbers to percentages where it makes more sense. It's easier to see trends, so you can really review your trends, negative and positive. You can spot changes that don't make sense, and it'll allow you to ask questions about why this happened and what changes you need to make to ensure your business is running efficiently, effectively, and profitably. It's pretty easy to do. You take your total revenue number, which is your denominator for the equation. If you remember math, you got a numerator and a denominator. But the key is total revenue is 100%. Everything is divided by total revenue. And then it'll show you what you're doing in different areas. So one thing that jumps out on me on this first page is in year 3, our cost of goods sold went up 5% from the previous year. That's huge. Why did that happen? What did we do that year that made that go up? That's something you should look at month to month to see what's happening so this doesn't happen to you. But you also notice they took positive action in this company to reduce it by over 14% over a 2-year period. Amazing. The second thing you'll notice on here that should jump out at you is the cost of employees is enormous. And the same thing in year 3, there were some bad management practices, and those numbers went up 6-7% from the previous year. The final number I would tell you to look at on here, and it really jumps out at you, it's the net income after tax for year 3 of 9.2%. That was 10% less than the previous year. Now, the company took positive steps to fix that, but these are things when you put it in percentages, you can quickly see what is eating your lunch financially, and you can make appropriate changes. Again, to turn this into a common income statement, it's really simple. Your total revenue is the 100% line. You take the dollar amount of any account and divide it by your total revenue. The example's right here on the screen. Total revenue was $550, wages was $125. We divided $125 by $550 to get us to 22.73%. If you do that for every line, you have a very simple statement you can use to spot anomalies, identify negative trends, and take positive corrective action for the future. The balance sheet is one of the things that scares me, frankly. They're confusing. They're hard to read. Assets equal total liabilities and equity. What does that mean, Dave? I hated accounting in high school and college. It was awful. I want to stick a fork in my eye. Really, the balance sheet is simply this. It is a snapshot at a single point in time of the company's accounts, covering its assets, what it has, what it owes, and what people own, shareholders' equity. The purpose of a balance sheet is to give interested parties an idea of the company's financial position, in addition to displaying what the company owns and owes. So don't make this complicated. Equipment and stuff needs to be on your balance sheet, not an expense. Remember that. Get your equipment off of your income statement and put it on your balance sheet as an asset as opposed to an expense. It'll help your accountants in the future. This is what a common size balance sheet looks like. This is a very simplified one. Basically, they take total current assets and they divide the number by the total current assets. Same thing with liabilities and equity. They take their total liabilities and equity as a denominator and divide each column and cell in the liabilities and equity chart by that number to give you a common size historical balance sheet. Statement of cash flows. This is probably the thing that will kill most businesses because they think they're making a ton of money, but they can't pay their bills and they can't figure it out. It's pretty simple. What do you got? Where did it go? It details all cash inflows and outflows during an accounting period. It identifies the sources and uses of cash, and it's critical in forecasting future cash flows and needs. As I started this slide, I said this: net profit does not equate to being cash flow positive. Okay, so why is that, Dave? What do you mean? Well, in some cases, some business owners are very good and quick to pay their vendors. In those same cases, some customers of businesses are not quick to pay the businesses. If you are paying your debts in a timely manner, but you're not receiving inflows of cash in a timely manner, then you have a problem. And it causes problems with your vendors because at some point you're not able financially to pay them back in a timely manner, and they get mad at you. So understanding where your aging reports are, your payables and receivable aging reports are, and what you owe and who owes you, and really, really aggressively attacking those numbers is hugely important if you want to maintain a exceptionally successful business and you do not want to worry about filing bankruptcy. The cash flow statement answers these questions. How are you obtaining cash flow to operate? Where is it coming from? Where are we spending money? And how fast are we spending it? What's causing the changes in our cash balance from the beginning to the end of a period? It allows you to identify problem areas, attack those, and fix them. The statement of cash flows is not hard to understand. It just tells you what's coming in and what's going out, when it's coming in and when it's going out. And those are really important things when you're managing a large company or a medium-sized company with a lot of employees, a lot of cash in and a lot of cash out. So there's 3 sections of this, pretty simple. Your operating activities, your investing activities, and your financing activities. Your operating activities are transactions that determine your net profit. It's cash receipt from sales, cash payments to vendors, suppliers, and paying your operating expenses. Investing activities are just the acquisition and disposal of long-term or fixed assets, such as fixtures, equipment, or property. Investments like stocks and bonds are loans to other entities. Realize that change in fair market value is not included because cash is not involved. Financing activities are external financial transactions. They're the cash inflows. If you borrow money or if owners invest money in the company, as well as your cash outflows, business loans that are repaid, and cash that is distributed to owners in the form of an owner's distribution. Operating activities, investing activities, and financing activities are not difficult, but you need to take them one step at a time to understand how they're impacting the overall cash position of your company. If you want to be successful in business, you have to understand what you're making and what you're spending. And you have to understand the easiest ways to increase your profit and your profit margin. So this sounds stupid, but I'm going to say it. You want to make more money, increase your revenue, decrease your expenses. The best way to do that is a combination of the two. First and foremost, you need to do a revenue analysis by category in your company's financial statements. So what are your product lines costing you? And what are you making? What are your service lines costing you? And what are you making? And what is each department costing you? And what are they bringing to the table? I'm going to give you a really, really simple example. You have salesman A and salesman B. Salesman A costs you $10,000 a month. Salesman A is bringing in $50,000 a month. Sounds pretty good. You got salesman B who's costing you $10,000 a month and bringing in $15,000 a month. What do you want to do? They're both profitable. Do they make sense? Is it covering their cost? In worst case, you have salesman C you're paying $10,000 a month, and they're bringing in $2,000 a month. Revenue analysis by category is probably one of the most important things a business owner can do to understand their financials, to understand what they're making and what's it costing. The key is to determine what has the greatest gross profit and double down on that area to grow your business. The second thing is to determine what has the highest gross profit margin. Now, just because you have the greatest gross profit does not mean you have the highest gross profit margin. So be careful when you're looking at it to make sure you balance both of those things. The next thing to do is look at your expenses by category. Determine where you can reduce expenses, what makes sense to cut, and realize you can't cut everything. I mean, some people will go, I'll just cut it all. No, you can't do that. There's some expenses that are good expenses. The key here is to think about alternative choices, like can you reduce time? Can you improve the processes and streamline your procedures? And while at the same time improving quality to make your customers happier? If you can do those three things in the expense category, you're going to do great growing your business and increasing your bottom line. Now let's talk about a revenue and expense narrative variance report. This gives you a tool to kind of look at your revenue and expenses and write down what's going on. It's a really good reporting and management tool. It compares the current accounting period with the previous period, and it details all major account changes. So you can really, this is a monthly and a quarterly thing to do to look at your company and see what you're doing and take that deep dive with your team to write down examples. I mean, the purpose of this, the purpose of the narrative and variance reports is to allow you to understand why certain accounts are going up or going down, continue the positive action, correct challenges or deficiencies immediately, and simplify the research later on. The really key thing for you here in business owners, I would tell you, review these monthly. Don't wait till a quarter. If you do, you're going to be far behind. Take a day every month and review your financials in detail and make corrective action. If you don't, you're going to be a quarter behind, 2 months behind when you could have corrected this right up front and not had a problem. The longer this waits, the bigger the challenge becomes. So here is a revenue and expense narrative variance report. This is what it looks like. Basically, we're going to take one line, legal fees. It shows in your current period, you paid $7,600. In the previous period, you paid $3,400. What happened? This is where you look at the narrative content, look back at the numbers to see what happened. And if it makes sense and you can justify it, great, justify it because A happened. If not, figure out what you need to do to keep that from happening again. Office supplies is another good one. Prior period, you were $1,263.13. This current period, you're showing $346.12. That's a significant reduction. What did you do to make that happen, and can you continue to do it to drive more money to the bottom line? You got to remember that each penny or dollar saved goes straight to your bottom line, and that's profit. That goes home to you and mama, or you and papa, whoever it is. Hopefully, you have a better understanding of how to look at your financials and be less stressed. Remember, take it one bite at a time. You're eating an elephant, take it slow. Don't get overwhelmed. Find an area and focus on it. What I tell you today, focus on your profit and loss. Focus on making sure your numbers are input in the system, whatever system you're using correctly, and focus on your profit and loss statements. Let's start there. Once you get that figured out, next look at your cash flow statements, and then finally look at your balance sheet. I would do it in that order because those are the immediate changes you need to make in your company. Realize if you do this and you do it on a monthly basis, you will be a financial wizard before you know it. Look, there's nothing to be afraid of. It's just numbers. Make sure they're right and make sure you're ready to grow your business to the next level. With that, I'm Dave Evans, and we are out of here.